This video is called the active hurdle rate. There is a lot of debate lately comparing active and passive management. Passive management has become very cheap and is almost free today, while fees for active management have not changed much. Therefore, if you're going to be using active management, your expected additional returns should compensate for the added expense and risk, otherwise it's not worth it. So we lay out a formula for evaluating the cost benefit of active management so that you can properly evaluate if it's worth pursuing. So what is active management? Active managers aim to provide a return higher than that of a broad index that a strategy is measured against, and it could be stock picking or market timing. It could be a large cap value stock picker trying to beat the large cap index, or somebody just trying to beat the S&P by picking stocks in that index, or a manager adjusting exposure to the index in the form of a timing strategy. Active managers charge a fee for both stewardship and the added research required in attempting to deliver those excess returns. So you have to pay extra, but the question is, are you going to make more than the passive alternative in order to justify the fees? So that's the real question. There are different ways to access active management, each with different fee structures. The first one is active ETFs. There are not many active ETFs, but fees for the ones out there are generally less than 1%. Most of the active strategies, particularly on the stock picking side, are in mutual funds, and those will typically carry a fee of 1 to 2% a year, and some of them have a load fee up front for getting you in, which is a bit of a ripoff and which nobody should have to pay anymore, but they don't carry a performance fee, so regardless of how they do, you pay the stated annual fee. Beyond that, you could go to a hedge fund product, and that is more expensive. Generally, hedge funds charge 2% of assets under management plus 20% of profits above some benchmark, and those fees are coming under a lot of pressure too lately, so you really have to be a pretty good manager to get people to pay you those high fees. And then there is one structure that is even worse than that, and it is called a fund of funds. You're paying somebody to pick the best hedge funds. So you not only pay the 2 and 20, but you also pay the fund of funds a fee to help you pick the best hedge fund. So that is just layers upon layers of fees and makes it very difficult to beat the passive index when you go that route. What we call the active or alpha hurdle rate is the required outperformance relative to its passive benchmark in order to be pari passu, in other words, on equal footing or no worse off than passive management. Active management will incur management fees, commissions, and taxes on profits, and if you're using an advisor, that's going to cost you more too. So there are a lot more fees with an active strategy. Here is an example of how the hurdle rate works, and we have used the hedge fund strategy as an example because it highlights it nicely. Let's assume that you have a passive strategy that will earn you 8% return, that's shown on the left. If you went with a hedge fund, paying 2 and 20 over a 4% hurdle after the 2% fee, and the hedge fund earned the same as the passive benchmark at 8%, you would end up paying the base fee of 2%, and then what's left over is 584, and the excess over the performance hurdle of 400 leaves 184, and so you pay 20% of that, leaving you with a net return after all fees of 5.47% with the hedge fund, assuming they just matched the performance of the passive index. And then lastly, on the right, we show how much the hedge fund would have to deliver just to equal the 8% in line with the passive benchmark. And in this case, the hedge fund would have to deliver 11.23% in order to keep you pari passu with the benchmark. You can go through these calculations on your own if you need to. So your expected return should be 3.23% higher than the 8% just to make you indifferent with the passive strategy. That's what we call the hurdle rate, the 3.23%. So you really need to think about whether that is achievable or not. And most importantly, you have to consider the level of risk that you are taking to get there. The hedge fund analysis assumes that the risk taken is the same, but if the risk is higher, then you would need a higher hurdle rate. So how much risk you're taking, that's very important, and that leads us into the style of active investing. There are a bunch of different styles of active investing. You can have systematic and discretionary, and then within both of those types, you can have either fundamental or technical strategies. The way we think about it is fundamental is more stable and less risky, so you would settle for a lower hurdle rate there. Whereas if it was discretionary based on technical, that would be a bit more flimsy or more risky, so you would want a higher hurdle rate for that type of strategy. The other thing to consider is the time frame focus. A shorter time frame has to rely more on data patterns than on fundamentals, so is less reliable. On systematic strategies, look at the backtest period, the live test period, and how the live test results match up with the backtest expectations. If you have a 50-year backtest period and it's stable, that's pretty good. With live tests, obviously the longer the track record, the better. So the key takeaway is that understanding the type of active strategy and the expected risk to reward ratio is key to determining if the additional fees are justified. So first determine what the hurdle rate is to keep you pari passu with the passive benchmark, and then think about it in terms of the type of active strategy and the type of risk you're taking on relative to the passive benchmark to see if you need to adjust that further. And so that's how you have to think about it. And by the way, in terms of hedge fund strategies, there are ways to replicate hedge fund managers with little expense. For example, you can track hedge fund filings for free and mirror them. They are delayed by 45 days or so, but they still provide some very useful insights, and many times the stocks have gone down rather than up from the time the hedge fund manager bought them. So that's an interesting place to look for insights. And so there are ways to sidestep some of those fees. But active investing can be expensive, so you need to make sure it's going to be worth the added expense. Thanks.